will have a forum session altogether here in Sotunya Hall. And the title of this session is How Can We Bridge the Gap Between the Impact Investment Industry and Zambia's Pension Funds? And to moderate this first session, allow me to invite Lombe Muzala Batunda, who is the investment manager at Prospero.
Good morning, everyone. Thank you so much. To basically kickstart this forum, I wanted to just throw around some high-level numbers. There was a recent study that was conducted in 2020 in 10 African countries. And those countries obviously included Zambia, South Africa, and Nigeria. And it was estimated that pension funds control about 357 billion US dollars in assets. Additionally, there was a study that was conducted by the National Advisory Board on Impact Investment in 2019. And in that study, it was estimated that Zambia's public pension fund, NAPSA, currently sits at about $3.2 billion. Now, if you're still wondering why this session is important, I will elaborate. Basically, when you compare and look at the numbers of impact investments recorded last year, you will notice that it's actually less than $50 million, only less than $50 million. And obviously, most of that is laid by foreign institutional investors, which is not a bad thing in itself, right? But then it becomes a challenge when there is a disruption in macroeconomic fundamentals. So when you have the high inflation rate, when you have currency volatility, that presents a challenge in itself. Now, coming back to this session again, in terms of how can we bridge the gap between the impact investments industry and pension funds, you will notice that clearly with those numbers thrown out there, there is need to get pension funds and other domestic institutional investors to get them active into investing again. And the reason that is because they present and they have better cushioning against macroeconomic fundamentals such as the kwacha volatility. So my name is Lombe Batunda, as earlier introduced, and I'm investment services manager at Prospero, which is basically an FCDO fully funded nonprofit that basically invests in market innovations and has the vision of making Zambia an impact investment hub in Southern Africa through the different partners that we work with, obviously being in the Impact Capital Africa and also the National Advisory. To kick off the session, I'll give each of my panelists 2 minutes to basically just give a high-level introduction about who they are and the organizations that they represent. So starting with my immediate left.
My name is Chibamba Kizito Lopa. I'm CEO for a company called Finbond Limited. We are financial services advisory service, going to financial services advisory. We've been operational for the last year and a half, but I think in the past I've played a few significant roles in the developmental finance sector. I was previously Chief Portfolio Management Officer with the Development Bank of Zambia. And before that, I used to run a fund called Growth in Zambia for 6 years. And prior to that, I was head of business banking for Zanaco. But as part of my contribution to Zambia, I've also been on quite a number of boards. And among them is I was in the immediate past vice chairperson for the Pensions and Insurance Authority. Thank you.
Thanks, Mr. Lompa.
Thank you. My name is Mwewa, Kyamulanda. I'm Director of Investments at NAPSA. NAPSA has been around for 21 years with the objective of collecting contributions, paying benefits, and investing excess funds.
My name is Basil Nundwe, and I work with Insight Capital Partners right now. My background comes from civil structural engineering. I strayed from the industry probably in the early 90s, and found myself doing venture capital and private equity. So I've seen this impact space evolve over time, initially with the Zambia Venture Capital Fund, which was an initiative by the Commonwealth Development Corporation in the early 90s that evolved into a Southern Africa Regional Fund, a $50 million fund that grew into our Aureus Africa Fund, which was a $400 million fund. And then on, there was a health fund that we raised for Africa. So I've seen the impact space grow from literally early stages in Zambia. And for me, it's a big opportunity and excitement to see for the first time, I think, some traction in this space. If you look at it in the context that the first venture capital fund was in the early 90s, and we still haven't seen too much activity in that space. So hopefully with this summit and the emergence of the National Advisory Board, that we'll get some traction in raising capital for this space.
Thanks, Mr. Nundwe. And we have Mr. Oguche Agudah joining us virtually.
Yes, thank you. All right, my name is Oguche Agudah, and I'm the Chief Executive of the Pension Fund Operators Association of Nigeria. It's the umbrella body for all the pension funds operating in Nigeria. And in that role, I lead the efforts of the industry to engage the various stakeholders, the media, the regulators, the government, the financial markets, international development organizations, so that we can help to, number one, protect the pension funds, the pension operators, and promote the operations of the industry, and also to help to ensure that pensions has a positive impact on national development in Nigeria. I'm also a member of the National Advisory Board for Nigeria, so I'm happy to be here. Thank you.
Thank you so much. And maybe to kick off this session, it actually makes a lot more sense to, just have a high level sort of like introduction. Do we even have regulation that could support pension funds in investing in alternative assets? Maybe Mr. Lombe, you can just come in and give us a brief on that.
Thank you. Thank you very much. Government has recently issued the statutory instrument number 50 of 2021 as part of the Pension Scheme Regulation Act. And this is the Pension Scheme Investment Guidelines Regulations of 2021. And I believe that this is in response to the desire to meet current market expectations and to enable the pension schemes have greater impact on the economy. I will speak only to those aspects in the investment guidelines, particularly affect the impact investment space in terms of treatment of various asset classes. The investment in property has had the upper limit expanded to 40% of the fund size. And I believe this was done mostly to meet the demands of the many pension schemes, because the limit was much lower before. And obviously, from an impact investment perspective, to seriously encourage infrastructure development, which we'll all agree here is a great impact. Another aspect is that investment in private equity has had the upper limit expanded to 15% of the fund size. And this is meant to increase the participation of pension schemes in viable private entities. And again, you will agree that this strongly helps to stimulate economic growth through the works of the private entities. What I also find extremely important and very good about the new investment guidelines is clause 17 of the SI, which allows a pension scheme to invest in other investments. This and the scheme will be able, in this respect, to define what these other investments are, and then get them approved by the Pensions and Insurance Authority, which is the regulator. And then they'll be able to participate in these other investments. This therefore creates a lot of room in there to really do innovative, profitable, and impactful things. A very cardinal thing that has come out from the new regulations is that pension schemes must have their own investment policy statement. So this is created by the scheme, approved by the trustees, and then submitted to the regulator, and it will serve as a guide on how the scheme invests. And the regulator really then works to inspect this into the scheme. And it is really important in that the schemes will be able to follow it because it is their own creation, and they'll do it very well. I would assume that in the past, because of the limitation in the asset classes and what they could invest in, the schemes should have felt that investment decisions were being thrown down their throats. My guided opinion, and really to agree with what Dr. Mwape had said earlier, is that the onus is now on the impact investment players to come to the party with the pension schemes, with their viable investments, as greater freedom has really been created by expanding investments on the upper limit on investments on property, expanding the upper limit on investments in private equity, and also creating an opportunity for other investments. And this is really a good thing. So my advice to the impact investment players is to acquaint ourselves with the dictates of the new regulations and get in the faces of the pension funds. And I think we are now in a very good space. This is a process that takes quite a long time, because before issuance of this statutory instrument, the previous one was statutory instrument number 141 of 2011. So a 10-year cycle, but I think a very informed position from the pension funds, which will enable significant impact investment if we just get into the faces. Thank you.
Thank you so much. And thank you so much for that detailed feedback. I think it provides a lot more insights in terms of what's currently existing on the regulation side. And I wonder, you did throw it to basically the impact investing ecosystem players to say that it's up to them to be in the faces of pension funds. I wonder if there is a willingness from the pension funds to diversify the way they invest. This is obviously, different from what they've previously been used to. And I wonder if Mr. Kyamulanda, you would like to just come in to just speak a little bit more about the willingness of pension funds, and more in particular, the national pension, the NAPSA, basically.
Right, thank you. Yeah, NAPSA operates under the National Pension Scheme Authority Act number 40 of 1996. This act has specific investment guidelines in there, and those guidelines encourage the trustees to follow certain investment principles, and impact is one of them. The others include safety of funds, because these are pension funds, so you don't want to get into venture capital with this type of liability facing. So there's also the issue of asset liability matching. So the willingness, therefore, is constrained by the available space allowable for private equity. So sitting at $3 billion, I think we're looking at $300 million available. But the limitation really is risk. The fact that these are pension funds require that ourselves and the trustees pay particular attention to certain elements of an acceptable deal. The challenge that we face, however, is that for SMEs, there's data opacity, there are governance challenges, there's poor risk management, and so on and so forth. So if we get organizations out there to sort of incubate some of these SMEs to bring them up to speed, I think they'll have adequate access. I think there's enough in the pool for private equity. We've done quite a bit so far, but there's still scope for more. So the willingness is there, to answer your question. Thank you.
So what I'm getting from you then is the fact that there is willingness, but the risk is still much higher for NAPSA. Is that correct?
That's correct.
Okay, all right. Maybe if I may turn now to Mr.
Oguche.
Do you have him? So I was just going to ask if there's been any strategies that have been implemented in other African markets, and maybe what your response would be to the comment on risk.
Yeah, I think it's the same everywhere, and probably the pension fund managers, they drink the same water, because it's the same also in Nigeria. You know, in terms of, yes, we need to invest more in impactful companies and impact investments. However, there's also the side of risk. And I think what needs to happen is that there needs to be either a coming together of both parties, on the one, on the pension funds, number two, those on the impact investment space, like the first speaker said. But I don't want us to get too hamstrung on impact as an asset class versus investing in the real sector. You know, and this is my own considered view. I've said a number of times that in Africa specifically, if you are investing in private companies, if you are investing in companies that are operating in real sector, then there is an impact. You know, in Africa, where a number of people are poor, women are excluded financially or in various places, as long as we can get money out to companies that are either providing power, providing jobs, you know, then we are making impacts. You know, if we get hamstrung in either trying to get a green building, trying to get green power, and then we can be on this for a number of years without putting the capital out. So for me, most importantly is how do we get capital and how do we get investments to the real sector and to people that need it, so we can lift many people out of poverty. You know, so in my view, you know, that is the most important. You know, if we look at, and we can do the two tracks. So we want to be environmentally responsible, we want to be socially responsible, and we want to get decent financial returns. But I think most importantly is a system that creates a platform where pension funds can get money out to transformational companies and transformational projects. And I think that's what we need to focus on. Thank you.
Agreed. Really agreed. And I wonder, Mr. Nundwe, would you think that there could be any de-risking mechanisms that could be put in place that could potentially lower the risk for some of these pension funds, given that that's the merger deterring factor?
I think yes. The short answer to that question is yes. From what I've heard all the speakers mentioned so far, the perception is that private equity from pension houses is capital directly into private businesses, which is one model. But I think is we should probably be looking at using private equity specialist vehicles where you pull in the capital. Pension funds would be a contributor in a syndicated pool of capital with the development finance institutions. And then you have that capital handed over to a fund manager whose sole business is to manage this kind of risk and look for impact. And these are the typical people where they deploy the capital and return the money to the investors. So rather than the pension funds invest directly into the private sector, they should probably do it through the vehicles of specialist funds to be able to do this. And if you look at just to speak the question of risk, if you look at the results that came out probably up to 2020, the last 20 years, decades, the private equity space has returned a better return than listed stock in that period. Now the two seem to be converging closer and closer for a whole host of reasons, but I think for Africa, we're still way behind. So that tells you that there's risk, but the return is reflected in the adjusted risk return. So there is scope definitely to do that.
Thank you so much for that. So obviously there's been this issue of risks, right? But there are also other issues that have come out a lot more in the recent past. For example, lack of capacity and maybe, you know, shifting it a little bit. So as opposed to focusing mostly on private enterprises, we move it, you know, a notch further and maybe also talk about the fund managers, which is another concept that you brought in, Mr. Nundwe. There's lack of capacity, there's lack of pipe, and that seems to be some of the challenges that people have re-emphasized on. Is there even absorption capacity to, let's say, take a ticket size of anywhere of $2 million? How many opportunities exist out there? Do you want to just maybe spend a few minutes to just talk a little bit about that?
Right. From our perspective, we think that to make sense for our fund size, ticket sizes $10 million and above will make sense. Smaller ticket sizes, we prefer to channel them through structures like what the ones Basil was talking about. But most commercial banks actually have internal capacity to handle. They've got investment banking teams that can handle some of these. When it comes to pipeline, like I indicated earlier, if you speak of pipeline in terms of the available pool, I think there's more than enough. But if you think of pipeline in terms of deal structures available, investment opportunities available, I think that is subject to risk. And also it's subject to the investment strategies of the different investing funds. For instance, we like the manufacturing sector because, you know, the impact, the value chain impact is quite the entire ecosystem, employment creation, and so on. We like the agro processing, all right, value addition in the agriculture sector. The likes of Basil and Kizito here will have, I mean, I think that they've got the capacity. It's just that at the end of the day, it's the investment strategy that matters. Lack of performance data, yes, that's true. To participate in the private sector, you'll have to have data. And as I indicated earlier, it's quite opaque. You really don't have financial statements for a lot of the entities out there. And also, I think what most people are looking for is venture capital. They're looking for angel investors, and by nature, pension funds really are highly regulated due to the fact that the liability itself, that's pensioners involved. You get public interest involved right there. So venture capital and angel investing, those are not asset classes that are within our purview at the moment.
Okay.
Thank you.
Thank you. And Mr. Lopa, just coming back to you, I wonder if there are any other financial intermediaries or investment vehicles that could be created or could be replicated from other markets that could increase the appetite for pension funds to sort of like start investing in these alternative assets.
Yes, I really believe there are. I mean, the investment vehicles that are currently being used in Zambia have been split into 4 major asset classes. You talk about equities or stocks, you talk about bonds, real estate, and cash. But as Basil said earlier, going forward, I would like to see explored and used greatly by the by the impact investment space. Here in Zambia would be mutual funds. And this, as explained by Basil earlier, would essentially be an investment fund consisting of monies put together by many investors. And I was hoping NAPSA would be really interested in this. And I hope they can be able to go and change their investment policies to accommodate all of us. But this would be primarily banked by the pension funds. And again, we are in agreement here that professionals are in place, really available and experienced to handle this. And talking about the willingness, especially of the big pension funds being in place, but the risk being too high for them, like NAPSA, really this can work to resolve that problem because the mutual fund managers would be more in touch with the smaller entities. We need to appreciate that we are in Zambia, and an investment of $10 million in a single entity is a lot of money. This $10 million could be used in quite a number of much greater impact. So obviously the large ticket size of 10 million and above that we were referred to wouldn't be so many. But I would like to agree with him. The pipeline is huge. We have professionals fully abundant and highly experienced to be able to handle this. I mean, Basil has been in this space for the last 30 years or so. And really, it's something that really needs to be looked at. Mutual funds pooling of funds so that the de-risking is done, it would be something that would take us a great way forward.
Okay, no, thank you so much for that. And Mr. Nundwe, just coming back to you, obviously in my opening remarks, I did touch on a little bit in terms of what the opportunity is and the advantage of having domestic pension funds investing in this space. Could you maybe just elaborate a little bit more in terms of what are the opportunities that exist to get these pension funds to begin investing?
It's a tricky question, but I think the promise of a good return is definitely what's there on the table. Where I see a real chance to do something meaningful, and we've been trying to do this for years, the first fund that was set up in the early 90s did not have any pension fund money in it. The second fund that came in around 2000 or thereabout, we went to NAPSA's door. We're doing a capital raise, and we couldn't get capital out of NAPSA for a number of reasons. I think one is regulatory framework, which was one of them. Also, the funds from the first experience was that if you do a fund that's in country exclusively, and then you have political risk or instability in that country, you have an implosion of the country, you lose your entire fund, which speaks to the risk that they're afraid of. So we then, I think as a group collectively, started looking at regional funds. So you set up a domicile elsewhere, not for tax purposes, but purely for the ability to be able to deploy capital in a number of countries. So you de-risk from a country perspective, and you do exactly the same thing for sectors. You vary your portfolio to across a number of sectors without necessarily having systemic risk in one particular area. So because of that evolution, we ended up doing regional funds for that focus. So I think the scope, the challenge we had with NAPSA on that first call was that they could not deploy capital outside of Zambia, which created another hurdle. And then because you've got the structure around the CIS, which is your collective investment schemes, and you have the trustees to govern the CIS, it made it extremely difficult for that structure to come and fit into the pool of a fund directly. So there's quite a bit of work, I think, if it's not covered now, to be done on how can you get the pension funds not to look at private equity as a CIS instrument and have the regulatory firm into that structure. So huge opportunity. But apart from that, if I say to you, the first venture capital fund that was set up then was virtually venture capital. 8, I think, out of the 12 investments were early stage businesses. Only 2 of them failed. They're still existing today. So something for NAPSA to consider is that by investing in these smaller businesses, it's almost a circular economy. You've put the money in, you may not get the full fog return on it, but because you've created sustainable businesses which employ people, your pull into NAPSA goes up. So you will not lose in the long term. You're going to have this circle going around for you to be able to gain. So I can't see a lose scenario, provided you can manage the risk and avoid total wipeouts.
That's a really good way of looking at it. If I may turn to Mr. Agudah, I hope I'm pronouncing the name correctly there. I apologize if I mispronounced it. But I wanted to just find out, are there any strategies, for example, again, that you can share with us based on the lessons learned in terms of what's being done in Nigeria to incentivize these pension funds to increase the flow to impact investments? Any specific strategies that maybe you can walk us through?
Yeah, thank you. I think, pulling together of funds is one. And because each individual pension fund obviously is thinking of the risk profile, they're thinking they don't understand the sector, or they don't understand the asset class, or they're just getting to understand the asset class. Because if we're honest, it's a new asset class for many pension funds, and even in Africa, it's a fairly new asset class, either infrastructure, impact investments, a new asset class. So instead of one pension fund investing alone, if many pension funds come together under a vehicle, then it makes more sense because number one, they share risks together. Number two, they share knowledge. And number three, if there is a hit, it doesn't come as much on one party, and then they help to check each other, because if you know that if many people come together, then evidently different people are looking at it. So instead of, one pension fund going into impact investments, if all the pension funds or a number of pension funds can come together under a vehicle, that is something that I think can work and will work. So that's something I recommend, the pulling effect, and that's something I'll definitely recommend.
Okay, thank you. And how's that working out so far?
Well, I think we're at the early stages of pulling, just getting people to understand, just getting people to be comfortable with it. And like I said, if we're honest, it's a new asset class. So getting people to understand at the initial stage is, and some people will get there before that. So we need to realize that this is a marathon, it's not a sprint. Some pension funds will get there before others. So it's just to work with those that do get there and show learnings. So we also spoke about data. So I love the fact that the Finbond is here, Prospero, which is sort of sponsored by the UK government. So we need learnings from outside Africa where it has worked, so people can see there's nothing better than a model that has worked elsewhere. So that coming together, pulling together of different pension funds, international development organizations, we'll get there, and we're getting there. It's a little by little, but we need to get there. And I think something that is very key is that if we don't do that as pension funds, there is a risk that we will become extinct after a while. And the reason is because the more investments that we make in impact sectors, in infrastructure, the more we create more jobs. As we create more jobs, there are more people that pay pension. So it's a loop that we need to understand that is positive. And one of the things I think about is, yes, people need to get returns, but of what benefit is the return to me if in 5 years' time, the whole earth is wiped out because of a health pandemic? So we need to begin to think strategically in terms of which areas can we invest in, not only because of the returns, but for our own enlightened self-interest. And that's something to think about. Thank you.
Thanks. Well, what's interesting is we've learned that NAPSA has about $300 million, is it? Yeah, available. And I just wonder.
The fund size is available. Yeah.
Nice, amazing. And I wonder whether Mr. Nundwe has been in touch and has been knocking on your door. Have you reached financial close, Mr. Nundwe, for Inside Capital?
We're actually in the market now, so
amazing. Amazing. Just also learning a little bit, maybe could you please just elaborate a little bit more about your fund, what sort of investments you've made, what sort of impact have you been able to achieve? And if you're in the market, how much are you looking at raising?
For the current fund, we're trying to get to 100 million US. The last fund was at 34, it was fully invested over 3 years. Some pretty exciting asset classes. I mean, one of them is one of my favorites is a business that does plastic recycling in the copper belt of the PET bottles. I mean, if you look at that from an impact perspective, it's just remarkable, from getting the pickers and the waste collectors, which employs right literally at the bottom of the pyramid on the chain, and you take that through the process, get it to the refinery, get it transformed into a product that then exported and used in the local market. So it forms. So we're very convinced that the idea of impact models work. What will be required, I think it's in another session I see somewhere else, is the idea of blended finance, because we will go for the full commercial return with the impact as a side spin. But some businesses are quite tough that way to have extremely high levels of debt in it, and therefore the idea of using blended finance as part of that construct would help. So, but I think the sectors for impact are huge, and we're seeing a lot of them in our pipeline and in our portfolios. So yes, we will be on that, so if they're open for business again. Yeah.
Really nice to hear. We've solved one problem already. Mr. Kyamulanda, I'm just wondering, I think you mentioned on risk as the main challenge. Are there any other challenges that you see in this space? And is it challenges that are sort of like industry-wide, or it's more specific to NAPSA?
Well, the only limitation is regulation. All right, regulation just allows 10% of the portfolio, makes 10% of the portfolio as available for private equity. We don't have venture capital, but I think it's for good reasons. Like I indicated, there's the issue of public interest. Every time NAPSA participates in a PE deal, you'll probably see it on social media. Yeah, so we've invested in some entities that are pretty good. They generate very good financial return, but they also offer quite a wide range of impact. The value chains are quite long, and then you have an opportunity to impact at every stage. We have something on the in Mwenelonga. We partnered with the IDC, the Kalene Fruit Company, and it employs about 120 people so far. You've heard about the Marco Polo transaction. We're sitting at 1,000 new employees. You must have seen the adverts recently. So that's new members into the NAPSA pool. And the return is quite good. It earns Forex, 60% of revenue is foreign generated. And so deals of that nature are quite rare, few and far between, mainly due to the issue of risk, of governance, and performance history. There's a minimum, I think, profit history that we ask for, maybe 3 to 4 years profitability. So these are the sorts of transactions that we would like to see more going forward. We've taken positions in infrastructure as well, infrastructure and energy. So just reviewing our corporate strategy, we're also reviewing our investment strategy going forward to accommodate some of the priorities of the, I should say, the new dawn government. Yeah. So I think that I still see infrastructure, energy as being on the top priority list. And so that's where we're going.
Interesting. If you don't mind me asking, how do you solicit for your deal pipeline?
All right, there's two methods. Sometimes we do a call for investment proposals, but sometimes they're just private placements. Just investment advisors like him or banks or any other institution, they just walk through and make presentations.
Okay.
Yeah.
Interesting. I'm being reminded that we're now only left with 5 minutes, and I wanted to sort of like extend it to the attendees to see if they've got any specific questions for my panel. So I will pause. I can see there's already a hand up. Can somebody please assist me with a mic?
Steve Beale from the British High Commission and chair of the board at Prospero. I was just going to quickly say, I think this conversation is really, really valuable and useful. Frankly, it's a conversation that's going on in more or less every country around the world. It's a conversation that's been going on in the UK for decades, to be honest, in terms of how to get pension funds investing more in a kind of wealth of kind of real world, real economy assets, particularly in infrastructure, I think, in the UK. I guess my question is really about, I think one of the things we're going to talk about later is the kind of climate survey report. And I think if you're an investor looking into Zambia, one of your biggest questions is often around exit. And I think particularly once you've put kind of high risk capital into investments in infrastructure or SMEs, and then once you've de-risked it and you've kind of built capacity, you then want to exit. So my question really is actually to NAPSA, but also others, in terms of the role of NAPSA in helping that kind of exit process for people that have already invested and have kind of taken higher risk positions, in terms of, and actually whether you've already been doing that from your perspective, or whether actually there's some kind of space. And I think particularly actually in infrastructure, that's the most common way for pension funds to invest in the UK.
We are not short term, and exit is only when there's pressure. But at this stage, we're quite okay.
Thank you. Is there anything you would like to add on, Mr. Nundwe? No?
Can you hear me now? I think as far as infrastructure, I can't comment on that.
Yeah.
But as far as the SME space, I think exits, if you structure it properly and you build a business for scale, you can achieve successful exits. I mean, it's been done before.
There was another question over there. You can please just assist with the mic.
Good morning. My name is Bruno Mwewa from Biofin. When you look at the ethos, I think of impact investment. You see aspects related to environment, some social aspects, governance, and those aspects. And I think when I look at the pension scheme investment guidelines, I think that were discussed. You actually see that some of the environmental and social aspects of, I think, impact investments are actually not well mainstreamed in these, pension scheme investment guidelines. And I actually see quite, I think, a huge gap. And I think we need to actually look at greening, I think these guidelines so that we actually infuse some of the, the green assets.
That we're undertaking that we're going through to revise the investment guidelines to accommodate asset classes such as the ones you're describing. We've seen proposals, but the structure is what we had issues with. I think that is the structure that came in. Then it had a foreign component in it. So we had to struggle. We had challenges with the structure, but basically the concept is acceptable. We are very much open to green bonds, and so I think that once the process is complete, once we announce our new investment strategy, you're going to see quite a lot of those asset classes being added to the pool. Thanks.
Just to add on to what Mwewa has said, I did mention that clause 17 of the new guidelines talks about other investments, and this is not defined. So you can, as a pension scheme, define it yourselves. So it opens a space for investment asset classes like what you have spoken about. But obviously, as Mwewa said, NAPSA is not governed by these guidelines, but I just pray and hope that as they work on their new investment policies, they do pick up things like this, and then we'll have a lot of play even from them.
So just in closing this session, I'll allow each of my panelists at least a minute just for any last minute closing remarks, if there are any.
Yeah, my few statements to end. It is extremely the pension scheme should be doing around the same thing. So let us get into their faces. Let us make sure they can hear us and we can make the change that we want to see. Thank you.
Thank you. My closing remarks, just to pick up from what Chibamba has indicated. Yes, NAPSA is we are reviewing our investment strategy, but in that review, with the pressure now that we're getting, where members would like to access their funds, if that happens, that just torpedoes everything. It means that now I need to de-risk the long end of the curve and sit in the short end as I prepare for this wave of withdrawals. So the question is, what does that do to impact investment? That's a question I would leave to the audience. Thank you.
My comment and maybe last thoughts on this is that I think it's always well and good to have summits like this, to have conversations on the trajectory and how the country is going to go forward. But I think the real crux of the matter is being able to get down to the granular detail and start putting the bolts together on how this machinery is going to work. Because if you leave it at this helicopter view and have these discussions, it'll just be that. And that's what I've seen decade after decade. It's just discussions. So unless you start putting down the building blocks, where do you start from, and put those together systematically and orderly, where there's deficits and weaknesses in the ecosystem, you bolt those up and put them together and see it go forward. So in short, a business plan, strategic in nature, that we can systematically monitor and see what timelines and building blocks have been made going forward. Otherwise, it will remain rhetoric. So.
Agreed. Really nice ending remarks. And if we have Mr. Agudah, do you have any last minute remarks?
Yes, I have a couple of remarks. I think one of them is to realize that it's not a sprint, it's a marathon. So we need to look at it as such. Another thing is that there are various ways to impact. We shouldn't just look at one mode. You know, we can either invest in private equity funds, we can invest in infrastructure funds, we can invest in bonds, you know, and when we invest in companies that are impactful, that is also impact. So it's not until we invest in a green bond or green affordable housing that is impact. So we need to look at things that way. We also need to come together, either as a community, either the Zambian Association of Pension Funds come together, because with that we can de-risk. And also international organizations need to come to the party also, share learnings, and be able to come up with structures that will also de-risk. Some of the things I've always advocated is some of the capital that is given as grants can either be used as first loss or in some other structures in blended finance that one of the speakers spoke about. Another thing is even when we invest in listed equities, we can also ask to either sit on the boards or demand from some of those companies to change some of their practices to be ESG compliant. So there are various ways to achieve impact, and we need to not just look at one way, but various ways and coming together to help this because it's in our own benefits as pension funds also. Thank you.
This is basically the end of this.